From CRI Simple Numbers, this is Profitability Playbook, the Simple Numbers Podcast, a podcast for those championing market growth and anchoring the nation's economy, small businesses, and entrepreneurs.
Hey there. Welcome to another episode of the Simple Numbers Profitability Playbook Podcast. I'm Mike Maxson. That's Brandon Gray. And we've been on the road like crazy the last few weeks. Brandon, what have we been doing?
Yeah, so I guess 2 weeks ago, we were at our semi-annual mastermind where we had about a dozen of our clients together in Santa Fe, New Mexico. I got to spend a day and a half with them digging into their businesses. They got some really great group coaching, tackled kind of top headlines and issues in all their businesses. It was a blast. Just some really great conversation. A lot of talk about AI. Where's it going? How are people using it? Some of those kind of things. I'm sure we'll have a future episode devoted to AI. Performance was obviously a top issue, especially, everybody that listens to the podcast is familiar with the economic conditions that we're operating in and kind of how that group was navigating through them. So that was a lot of fun. And then we went down to Dallas, Texas. Flew out the middle of a tornado, which is not recommended. Little bumpy.
It's a bumpy ride.
It was bumpy. So went down to Dallas and spent some time with Team Leg, which is a Serve Pro franchise. And one of their divisions that they specialize in is called reconstruction. So, when you have a disaster in your home, many times there has to be some construction and some building back and what have you. So, I don't know how many, what was there? Probably a couple hundred Serve Pro franchises there.
Easily, yeah.
Yeah. And, man, you talk about a fun group that was just anxious to learn about simple numbers, had a ton of energy, a lot of questions, which was great. We loved it. And so got to spend a couple days with them and go over some content and learn more about their businesses. And so, it was good.
Yeah, absolutely. Crazy whirlwind though of a few weeks. Glad to be back at it here on the podcast. So today we're going to go over our business health score that we created out of this office to really kind of monitor the health of clients. Like, hey, answer these few questions, and we pop out a score. And what me and Brandon wanted to do today is go through the components of that. What is in it, what's required, where does it need to be, all that fun stuff surrounding it. So if you, I'm sure we'll eventually carve out, that for people calling or emailing or what have you. But today we just wanted to introduce it and go over it. So Brandon, kick us off.
Yeah. So I guess, when you look at the genesis of it, it was something we've been kind of thinking about in terms of, we talk about a lot of numbers. They're simple, but there's a lot of them. Everything from, growth to OpEx to labor efficiency to return on marketing spend to leveraging of overhead to profitability and core capital and trade capital and launch capital. There's all these terms, right? And so one of the things that kind of helped push us to just finalizing this was we do a monthly column for a newsletter, 21 Hats. If you're not a subscriber to 21 Hats, you need to be. It is the best place to get a daily newsletter on what's going on that's relative to entrepreneurs. Lauren Feldman and his team do just a phenomenal job. And so once a month, we do a column that's basically on what's going on out there. What are we seeing in the 100 company model? And Lauren had mentioned to us a while back, he's like, well, if there was just one number, like the Dow Jones, you got one metric there. What would that metric be? And so we got to working on that a little bit deeper. And what we've landed on, this is a working title. It could change a little bit, is a business health index. So just think of, if we could give your business one number on a scale from 100 being just super healthy and everything's great in your business to 0 means you should close the doors immediately, where would you fall? And what would
Brandon, wouldn't my health score just be if I'm 20% profit, good job?
It's a component. but that's like, that's like saying that you have low cholesterol, but you have super high blood pressure. Okay. Was that good or bad? No, I mean, I mean,
I just wanted to get you answer. I just wanted to get you answer because that's gonna be the question. That'll be the question. Who cares? I'm 20% profit.
I can share with you a lot of entrepreneurs who have great profitability, but not a healthy business. It's not just about profitability.
Agreed.
It's a big component. Don't get me wrong. And so you got to kind of take a more holistic approach. So what we've done is we've created this scaling, or this grading rather, on a scale from 1 to 100. And I'll give you just a quick overview here in a second of as we applied it to our 100 company model, some trends we're seeing there. But let me go through the components, and Mike, let's talk about these and why they're important for an entrepreneur. And I think you guys as listeners today, jot these things down, these areas that we're measuring health in, and take a look inside your business and see, okay, do I see health there? So the first one, and these are not in a particular order. One's not more important than the other. As a matter of fact, they're pretty equally weighed. Gross margin growth. So for our new listeners, we define gross margin as revenue less your non-labor direct costs. Don't include labor. So it's just simply material, supplies, direct costs, those kind of things. Some folks will not have any. If you're a professional services business, you may not have any outside cost other than labor. So gross margin and revenue would be synonymous in that instance. But gross margin growth, as you look over the last 3 to 4 years, what have you seen in year-over-year growth? And right now, and based upon how we weigh it, if you're growing by 15% or above, you got a perfect score. There's 100. So the last 3 years, year-over-year growth, not just in 1 year, but the last 3, year-over-year, you've grown by at least 15%. That'd be, hey, rock star, great. If you are below 10, then you're going to fall below the 50% grading on that. And if you're, below 5, you get a 0. So you've got to be growing margin. Mike, why do you think we got to grow margin? What are your thoughts on that? Margin dollars. Why do we need to grow it?
Well, because it's your true top line of the business. I believe in business 101, everything happens at the margin. So if, you want to make, you got to grow your, I don't know what else to say. You got to grow your margin.
Everybody's heard the
first
saying.
dollar you get to spend internally. Yeah. First dollar you get to spend internally. You got to buy labor with it.
So you're not growing your dines. And I would say, and I think this is going to be the case for years to come. If you're not growing it by at least 10%, you're not going to be able to effectively outrun inflation. You can look at it and you go, well, I grew 3%. Well, everything else in your business went up 5. You're going backwards in bottom line. So you got to have that momentum. Now, when we say growth here, we're looking at dollars. We don't have a metric to determine is that growth due to price increase or growth due to volume increase. Well, that's the one thing we don't have insight into. Now, in the short term, price increase gets you there. But long-term wise, you got to combine price increase with volume increase because the price increase lever is limited. So first one we looked at was gross margin growth. The second one, you guys have heard us hound this one to death. Profitability to gross margin. Not to revenue, but to gross margin. You're just simply taking your net income, dividing it by gross margin. If you were 25% or above, it was a perfect score. There's not a lot of those out there walking around, by the way. I mean, that is humming. Okay. You kind of fell in the healthy medium metric if you were between 10 and 20%, somewhere in the neighborhood. We've said 15 is kind of should be your minimum. So that kind of puts you, healthy, but maybe not rock star. And if you're below that, obviously we got problems. As a matter of fact, if you're below 5%, you got a 0 in that column. So the profit matters. It is an effective measure of to one degree of health. It's not the only one, but we definitely got to take that in consideration. Right. So if you're growing and you got profit, We got 2 of the 4 we're in good shape with. The third, Mike, what would you say one of the next things you'd want to look at inside of a business to determine health?
Got to have that money.
Capital. I don't know where the term capital came up. I don't know the genesis of that term, but when we say capital, we mean cash. It'd be a lot easier just to call it cash, right?
Yeah, such a fancy way to say it.
It is. It is. Capital. Okay. So if you guys are followers of simple numbers, you've got both simple numbers books. You've heard our definition of what it means to be a fully capitalized business, meaning I can sleep well at night because I have plenty of cash in the bank. So that's going to be defined as cash minus any line of credit balance. It's okay to have a line of credit. We prefer in most cases that it be at 0. And your taxes set aside. Okay, if you're a flow-through entity, got the taxes set aside, it's not considered in that. We then compare that level, cash minus line of credit, to 2 months of OPEX and direct labor, general rule of thumb. So we kind of look to see, okay, how do you rate based upon that? So if you got full 2 months, meaning, hey, I can cover 2 months of my OPEX and direct labor without an additional dollar of profitability inside my business. You're in really good shape. You're very healthy. If you got a month, you're still okay. We can live with that. If you have less than a month, that's where the score really starts dinging you. And if you're negative, you get a 0. And you think, how can I be negative? Well, I have a cash minus my line of credit is a negative amount, meaning I owe more than what I have in cash, which, there's a lot of businesses out there that are in that position. So it looks at, okay, do I have cash to do what I need to do? Now, I will give you a disclaimer on this one. If you carry inventory and AR in your business, you will most likely be at a negative core capital level. Just in a handful of cases, you're not, but generally speaking, you're going to be. So an alternative of looking at that is also to look at what type of ceiling, how much room do I have on that line? Should I need it? So you can kind of filter and kind of look at that as you kind of evaluate your business. So we can get to that 2-month level. So we talked about margin growth, talked about profitability, talked about how much cash you have. The last component in looking at this health index is momentum. So what kind of momentum does your business have? As you look at it, is it a roller coaster up when you're down the next, up when you're down the next, so forth and so on? Is it this nice steady curve upward? It's been going down and now it's starting to move up? So it's just our way of trying to determine how legitimate is the performance? How likely is it to be able to continue? And so we just kind of looked at a deviation in profitability over the last 3 to 4 years with a business. Is it volatile, or do you have this nice kind of, upward trajectory to where, you're growing year over year profitability? Think of it in terms, if you were going to want to buy a business, what would you want there? You definitely don't want a declining trend. You're probably not real happy if it's like every 2 or 3 years they get a pop. You want repeatable profitability. And so we kind of looked at that, how much deviation's taking place there. And so when you put all those components together, that's what we rated them, gave them a scale, and then added them up and to see, okay, where would you fall? Where would you be at? So if you're above a 50 or so, 60, you're in pretty good shape. If you're between that 60 and 40 level, it's okay. You start to drop below that, that's where it's like, all right, there's some things we need to fix inside this business. And what we really like about it is you could look at it and go, yeah, I'm really profitable. Great. But I have no cash. The profitability is volatile and I'm not growing. Okay. Was that a business you want to go buy? Probably not. Or, hey, I'm really growing, but I'm not profitable and I have no cash and I can't repeat the growth. Is that one you want to go buy? So I think it does a pretty good job of being able to kind of look at it. So I think those are some things you guys can look at inside your business. We're happy to take a look for you as well. So, you can just get in touch with us, message us on LinkedIn, go to our contact page, simplenumberscri.com. and say, hey, I want to learn more about it. I want you guys to take a look, and we can pretty quickly kind of take a look at where you are health wise, and perhaps guide you a little bit there. So those are a handful. Mike, any more on that before we talk about what we're seeing as we apply this health rating?
Yeah, that's what I was going to ask you. My first question was going to be, hey, so we have this data. What has it told us so far? Because I think everyone's going to be surprised, or maybe not, when they hear it, because it was enlightening when it got put to everybody in there. And I will say this, I know my clients, that are doing real well, in all these areas, and when we have applied it, it has shown they're doing really well, and vice versa for the other ones. So it's very interesting. So yeah, Brandon, tell me what have we seen when we put it to the
Yeah.
test?
So as we're kind of working through it and trying to finalize it, we ran through with our 100 company model, giving every company in there a score. And then we asked each consultant that works with that with each company, because you're going to be more familiar than anyone else is on our team, of is this accurate? Does it speak? And there were a few outliers. I mean, there's a handful of times to where there was either something in the data that kind of distorted something, or, there was a case to where you had an anomaly revenue or expense event that needed to be isolated. So, but I mean, those were somewhat minimum. So, like anything else, sometimes you go to the doctor and you get the test performed, and they say, you got to come back because something looked odd. We got to redo it. There's going to be anomalies inside of business. But what was interesting is we went back and looked at this from 2021 forward with our 100 company model. And like I said, I'm not going to give you the specifics. We're releasing those to our clients first. Then we'll have a follow up on it later. But I will give you what we're seeing in terms of trend. To no surprise, the trend is declining. If you go back, I mean, there is a 10-point decline since 2021 in the metric from where we were at. So you just think, in terms of, and that on a scale from 1 to 100, if something moves by 10 points, it gets your attention, and part of that is you kind of look at the story of what's taking place since that point in time, and then try to apply that and project where is it going. So let's go back to 21. 5 years ago. Hard to believe. Seems like yesterday.
Things went gangbusters.
Yeah, seems like yesterday we were all kind of trying to figure out which way's up because of COVID. But 2021 we had kind of started to come out of COVID. People had a ton of money. I mean, you're coming off some of the best years in compensation, bonuses, business performance, and free money issued by the government. And so 2021, there was a lot of spending going on. Now, could have been a good thing, may have been a bad thing. There's a byproduct of that we're going to talk about in just a second. So 21, it's really healthy. It looks really good. Businesses are performing. You get to 22, and in Q1 of 2022 is when the first interest rate increases started. And so when I think what's important for everybody to kind of get our hands around is whenever fiscal policy is implemented, it takes a while for it to move through the system. So, you didn't see the mortgage market and housing sales change immediately once interest rates went up. It took some time. You didn't see commercial construction shift and change. It was like a year and a half later because all these projects are in queue. So it takes some time for all that to run through the system. But in 2022 is when you first started to see that happen. And we actually saw by the end of 22, we had seen a decline in the health metric from 21 to 22. From 22 to 23, it stayed level. It didn't really change, a few tenths of a point. It was pretty stagnant. And that was the market kind of acclimating to what was taking place. Not only did we have interest rate adjustments, but you think about why did we have interest rate adjustments? Well, it was the Fed's attempt to control inflation. It was also during that time period to where our data shows, this is crazy, inflation was exceeding 10%. Now, I know the Fed number never got that high, but we were, year-over-year cost increases, we were seeing 10%. Ton of wage inflation. You had the supply chain substantially disrupted in COVID, and it was trying to catch up. And you had, I mean, just a lot of things happening that were driving inflation up. And so you see from 22, 23, businesses acclimating to all the changes that are starting to take place in that environment. You move from 23 to 24, and there's a slight decline. It's not super massive, but a little bit. And you start to see it cooling off. Keep in mind, what happened in 24? It was an election year. Now, in 22 years, something like that, of doing this, I had never really seen an election play a huge impact across the board. You know, if you're in oil and gas or in government contracting or some of those other things that are directly tied to government spend, yes, you see it. But this time we actually saw it. We saw, and we talked about it on the
I
podcast.
think everybody said during that time, I swear it was more than I've ever heard is, I'm going to wait till after the election. I'm going to wait till after the election. And then their customers on spending money, like a contractor would go to a house like, hey, I thought we were going to do this, remodel. No, we're going to wait till after the election. It was like across the board.
It was everywhere. It was everywhere. So in the 24 election happens. There's this really interesting window that takes place at the end of 24 to about March of 25. The election was over. All the pent up demand started flowing through. Rates had actually started coming back down just a little bit. The Fed was kind of giving up of, and we're not going to be able to control inflation completely. Maybe we can't get it all the way to our target, yada, yada, yada. So we're just going to leave rates where they are, decline or lower them a little bit. And you saw momentum. And you had about 4 to 5 months of that. And then tariffs started. And it was just a wet towel thrown on the fire. I mean, it completely stifled it. And so you had a pretty decent decline from 24 to 25 in that metric. So, like I said, you kind of look at it, 21 gray, cools off quite a bit in 22, stays flat, a little bit of decline, 22 to 23, 23 to 24, a little bit more, and 24 to 25, it starts to fall again. And so that's great, context around it, but does it help you be profitable tomorrow? No, it doesn't. The only thing that helps you is, okay, well, where's it going? What do we see in businesses as we kind of apply this metric and what we're seeing? We don't have the final data, obviously, up to, I think we got through like February in the 100 company model, but we're continuing to see it decline. So you look at the components. What are we seeing shift and change in that? So gross margin growth, we're definitely seeing declining very quickly. So you've heard us talk about this 1,000 times. I got to go steal market share. What have I got to do to steal market share? Who are my competitors? Why are people using them? And what have I got to do to go take that business? That is the biggest challenge. And we saw that in the mastermind model, Mike, as we were having those conversations.
Yeah, that was crazy.
Yeah, I mean, and these are the best of the best. It's a challenge. You have got to figure out a way, and you heard us talk about competitive advantage and messaging and all those things on these previous podcasts. That's still the number one thing out there you've got to figure out how to go and do. Okay? Because that's where it all starts, as Mike said. It's margin becomes kind of that first dollar I can spend inside my business. And so I've got to find a way to grow the gross margin dollars. All right. When it comes to profitability, if I can't grow the margin dollars, I have to look at my payroll spend and I have to right size. Flexible labor. That's going to be your best bet in most cases right now. I've got to kind of make that shift and that change. If I do those things, capital will start to be created because I'll have profitability. I got to start to build capital. And then I got to find a way to make it repeatable. Systems and processes inside your business. One thing that is very present right now, and I'm going to go out on a limb, make a prediction, and everybody can tell me how I was wrong in 3 years. I think volatility is going to be more the norm as we move forward. So if you don't believe me, kind of take these two things in consideration. And one we've talked about a lot, demographics. Okay. We know the both rates are down. We know we got less people, less consumers. That's why you got to go steal business, right? So in that type of environment where the overall market's not growing, it lends itself to more volatility. And secondly, when you just look at the world political climate, it's nuts. If you don't believe me, go, look, what it cost you last time you filled up?
Yeah. I feel like it's always something right now. I don't this is and I mean I get there is something usually, but this has probably been these last few years here, really from that COVID time. It's been nothing but it's just something. It's hey, it's COVID. Oh, hey, it's pumping the money in. Oh, hey, it's now the interest rates are high. Oh, now there's massive inflation. Now there's tariffs. Now there's Iran. Like that, they're just and now what high oil prices. I mean, it's just like, I mean, we can't even um I mean, when can there just be gridlock and nothing happen? Like just you know what I'm saying? I mean, just I mean, it's crazy.
I'm a fan of the free enterprise system. And so if you leave it alone, the system takes care of itself, right? But we just can't get it left alone for that to happen. So, given that environment,
It consistently suck.
no, and if so, then it takes care of itself and you start to build back up. But I mean, we won't leave it alone. And so it's like this scab, we keep picking at it and it never heals. Um, you've got to move very quickly. When you've got a way to go steal market share, you got to move quickly with it. When you've got a competitive advantage that you need to put out into the marketplace, you got to move quickly with it. When things change in your marketplace, you got to move quickly to adapt to the change. And for entrepreneurs, that gives us a huge advantage. We are much better at dealing with volatility and change and adapting and finding a solution than the bigs are. So there's opportunity out there without a doubt. But like I said, buckle up, because I think those are the folks who can grow margin, who can steal market share, flex their labor, be really smart with marketing in order to grow and what have you. And right now, I'll have conversations with clients and they'll be like, hey, I got some extra cash and I pay off debt. Well, you got to look at each situation individually, but in general, I want cash. I need cash in the current marketplace because cash is fuel. It allows me to go places and do things. And I've got to have an effective strategy of how I'm going to reinvest cash. So, lot of balls we're having to juggle. So, but we're here to help. We can help you with them. Let us know. Hey, Mike, speaking of helping folks, and I didn't plan this, but this is a great time. Speaking of helping folks juggle those balls, Simple Numbers Summit.
Coming up.
November 9th through 11th, Austin, Texas. There's going to be a few more updates coming out here. As a matter of fact, Mike and I have a meeting today with our corporate marketing team on some of those things coming out relative to agenda, speakers, and all of that. We do have the early bird discount in place. So if you're listening, you need to be at the summit. I'm telling you, the value you're going to get from just being able to be around the Simple Numbers community and other entrepreneurs is going to be multiples worth what you pay to go out there. So go ahead and book it. Go to simplenumbersummit.com.
Pretty straightforward stuff. I mean, stuff we've talked about, but how it applies to the health score, I think is sort of, simple numbers-esque of how we put it in there. But I think everyone needs to know is like, hey, you got to drive gross margin, got to control your costs right now. And, be diligent with every dollar. The money is not flowing like it was. And so that's sort of the premise behind that health score, was really to dial in and to see where people were at, because they want to know. And like Brandon said, it's not just about profit. It's not just about revenue. We needed something to take in all those components for a business. Cause I have some that are great cash and are just bleeding out everywhere else. So it's it's a good tool. So I'm glad we got to talk about it.
Awesome. See you guys.
If you want to know more about driving sustainable profitability for your business, or are interested in learning more about CRI Simple Numbers, please visit our website at simplenumberscri.com. Thanks for listening to this episode of Profitability Playbook, the Simple Numbers podcast. You can subscribe to Profitability Playbook on Spotify, Apple Podcasts, or wherever you prefer to listen to podcasts. If you like what you heard today, please leave us a review. This podcast is brought to you by CRI Simple Numbers LLC, a division of CRI Capital Group LLC, and a subsidiary of CRI Advisors LLC. CRI is the trusted brand under which Carr, Riggs and Ingram LLC, the CPA firm, and CRI Advisors LLC, along with its subsidiaries, deliver professional services. Please note, Carr, Riggs and Ingram LLC is a licensed independent CPA firm offering attest services, whereas CRI Advisors LLC and its subsidiaries specialize in providing tax and business consulting services. These entities operate within an alternative practice structure as defined by the AICPA Code of Professional Conduct and comply fully with applicable laws, regulations, and professional standards. Ready to simplify your business finances and drive growth? Explore valuable resources, books, and tools designed for entrepreneurs and small businesses at simplenumberscri.com.